Hello everyone. So this video I'm recording about how to define our daily bias. So first we need to know why are we making this topic of bias as the first video. So the reason for that is whenever we are trying to trade, the first thing that our mind is to decide in which direction we want to trade. Like if we are bullish, if we are bearish. Because if we don't know the direction, what we will do is we will take trades on both sides, right? And chances of getting chopped up in market increases. So before entering our trade or before applying our strategy, our first objective is to determine our bias. So let's first decide what a bias is. So when we say bias, in simple terms, bias means direction. So what is our direction for the trade? So whenever we come across this term bias, so like if we say if someone asks us what is your bias for gold today, so most often the answers we will get is I am bullish or I am bearish. But that's not true. There are more than two answers for this question. So what are three possible outcomes for a bias? So when we say bias, it means direction, right? So bias or direction. So what are the possible outcomes for bias or direction? So the first one is bullish. If we are expecting price to go bullish or go up, we will say our direction is bias. Our bias is bullish. And if we are expecting price to go down, we'll say our bias is bearish. But these are not the only options. There is a third option, which is no bias. So why I'm saying there is no bias? Because when we mention bias, it means we have some logical framework or some logical explanation why we are expecting price to go into certain direction, right? So sometimes what happens, the price is in such a position that we are unable to decide, or we don't have any logical explanation like why it should go to either of the direction, right? So which means what, we are not able to decide which direction is more probable. So when we say we have a bias, it simply means we have our logic, our probabilities that are favoring one direction. But sometimes what happens, suppose market is not going anywhere, it's just chopping or it's consolidating. What happens, both sides are equally probable, right? Both price can go up or down 50-50%. The chances are at 50-50%. So in that case, what will happen, people who doesn't consider this no bias as an option, they will try to frame a bias either bullish or bearish based on the lower time frames, and this is where most of the traders get failed. Because what happens in this situation, that you are somehow trying to frame a trade which does not have a higher time frame bias behind them. So like this is the time when you need to sit out of the market, but what you are trying to do is you are justifying your trade idea based on the low time frames. So this is the thing that we have to learn first, that when there is no bias or there is no clear direction, we need to avoid that pair, or we look multiple pairs, right? So there are two choices that we have. We either only observe one pair, and when there is no clear bias, we stay out of the trade, or we observe multiple pairs and we only select where we have a clear bias. So the choice is yours. Now, when we talk about bias, and as the title suggests, we are trying to figure out the bias based on CRT as well as quarterly theory. So when we talk about CRT, we have three situations. Actually, all are aware of CRT concepts, but I'm still covering a little bit of it. We have three situations. It is either continuation, or it's a reversal, or it's consolidation. So when the candle, now this candle could be weekly, it could be daily, it could be 4 hours, whatever time frame you are finding the bias for. So if the previous candle closed above, if the current candle closed above the previous candle high, that means we have more chances of the high of the current candle getting hit, right? So if the price closed above the previous candle, we are expecting a continuation of the trend. This is from the CRT concept itself, nothing new in that. And the second case is when this candle takes the low of the previous candle and closes well inside the range of the previous candle, which is the usual CRT model, where this current candle becomes the second candle of the three candle CRT, right? So in this case, we have a reversal in place, right? And the third situation is when we have the current candle not going outside of the previous candle range. So this is the consolidation situation. So consolidation situation when both high and low of previous candle are intact, they have not been taken out. Right? So how do we decide bias based on this? So when we have a continuation and this current candle close above the high of the previous candle, we have more chances that the high of the current candle will be taken out in the next candle. Right? So in that case, suppose here in this case we closed above, so our bias is bullish. So we are actually targeting this high to be taken out. Right? In the second case, this second candle took the low of the previous candle. It grabbed all the liquidity from here and then it closed well inside this. So now what happens when the third candle opens? Our target becomes these highs, right? And in the third situation, which is the consolidation, what happens? The second candle stayed inside the range of this candle, right? So now what we will do, we will, based on what the higher time frame was doing, suppose we were bullish on higher time frame, so weekly we were bullish and these are the daily candles. This daily candle stayed inside the previous day. So when its low gets purged, we have much more chances that its high will be taken out because it follows the higher time frame or the floor high time frame bias. Right? So that's how the CRT helps us to decide our bias. But if we go just with the CRT concepts, the accuracy of this stuff becomes less because these patterns also fail, right? More often, right? So we need some more confluences so we can increase our the accuracy of finding the biases somehow, right? So, and one more thing before I move on, whenever we are going for the continuations, we don't need higher time frame key levels, which are talked about in CRT courses, right? So whenever we are going for the continuations, we don't need higher time frame key levels because we are already going in the direction of the order flow or the high time frame bias, right? But when in like in second case, whenever we are going to reverse, this reversal can only happen at some key level, right? So if these are daily candles, we need at least daily or higher time frame key level here, which can turn the price around, right? So now we have the idea of finding the bias from the CRT. Now we go on to quarterly theory. So what quarterly theory says? Quarterly theory says when we were trying to find the bias based on the CRT, we also have to check with the correlating pair for an SMT. Right? So how do we proceed with that? Suppose we are looking at the weekly cycles. So what is a weekly cycle? Weekly cycle is the quarters. The weekly is divided into 4 quarters: Monday, Tuesday, Wednesday, Thursday. Right? These are the 4 quarters. Friday also a quarter, but based on the quarterly theory that we divide all the cycles into 4 quarters. So for the weekly cycle, we take Monday, Tuesday, Wednesday, Thursday as the cycles. Friday is also another cycle which we can include, which we include in fact. Right? So similarly in the monthly cycle, we have the 4 weeks are the 4 quarters. In the daily cycle, we have Asia, London, New York AM and New York PM session as our 4 quarters. Right? So everywhere it's 4 cycles. Right? So suppose we are looking at the weekly cycle, that means we are looking at the daily candles. Right? So what happens? So this is the monthly cycle. This is the Monday candle. Sorry, this is the Monday candle, daily candle, and the Tuesday takes high of this candle. Right? Tuesday takes low of this candle. Right? This is the low of the candle that was taken here. If this is the suppose this is Euro USD. Okay. So at the same time we will check GBP USD, which is the correlating pair. The low of the Monday, low of the Monday was taken out on Tuesday on Euro USD, but it was not taken on GBP USD. Right? So we have a crack in correlation here, right? So the same candle, this Tuesday candle, did not take low for GBP USD. Right? So what will happen? This kind of price action will happen. This is the weekly cycle. This Monday low was taken on Euro on Tuesday, but the GBP failed to do so. So we have a weekly cycle SSMT. What is SSMT? SSMT is when the consecutive 2 cycles, consecutive 2 quarters have SMT. Right? So that is sequential SMT. That means Q1 has SMT with Q2, or Q2 has with Q3, or Q3 has with Q4, or Q4 has with Q1. Right? So it should be between the 2 consecutive cycles. So this is the daily candle. So when we are looking for the weekly cycle, we are looking SMT between 2 consecutive days, and because it is daily, so we look on the hourly charts. So this hourly candle took out the low of Monday and closed inside. Right? Now what happens? This was the last bearish candle. As soon as price closes above it, now we have a confirmed SSMT on Tuesday for the daily cycle. So what happens now? If you know quarterly theory, you know from here only we can trade for the bullish prices, which is same as trying to trade this week here, right? Now, but that is not the topic of this video. How do we trade this week? Once this candle closes inside and this Tuesday is closed, now what can we see? We have a SMT here. Also, we have a CRT here, right? This was the CRT candle 1. This was the CRT candle 2 that closed inside the candle. So now on the Wednesday, we already have a target, that is this CRT. So we can expect Wednesday to be a bullish day, right? Similarly, this was for the daily, right? Now, if I go for the monthly cycle, monthly have 4 weeks, right? So Q1, Q2, Q3, and Q4 are week 1, week 2, week 3, and week 4. When we go for the weekly cycles, we had days as our quarters, and our SMT was confirmed on 1 hour. When we go for the monthly cycle, our weeks are our quarters, and we will confirm our SMT on 4-hour candles, right? So this was the previous week low that was taken this week. These are not weekly candles, these are daily candles. So 1, 2, 3, 4, 5. These 5 candles are the previous week, right? So this week opens, suppose this is the Monday. Monday goes down, Monday takes the low of this previous week. This was taken on this asset, but it was not taken on the correlating asset, right? So it becomes what? It becomes a monthly SMT, right? Now this candle takes the low. Once price closes above this 4-hour candle, it becomes our confirmed SMT, which is one thing. If we have to trade this candle, we can trade from here based on the lower time frame that we will talk about later. That is double SMT confirmations. But once this price takes the low and closes inside, it becomes what? It becomes our when this week closes, it becomes what? It becomes our weekly CRT, right? So for the next week, we can expect a bullish price, right? Now, how do we use this thing on the candle closures? See, this was the Monday candle. The Tuesday goes down, takes out the low, fails to take out low on the correlating asset because it was daily. So this was the 1-hour candle when it closed above here and the price closed here. So when this candle closes, our next Wednesday candle is expected to be bullish. So now once the price opens here, we are very well aware that from here all we have to do is look for the bullish prices up to when the next liquidity target, right? So it could be a weekly high, it could be a daily high, it could be some fair value gap or something that we can target, right? But once this day opens, we have a clear mind that we have to go bullish on this day, right? So if we start from here, you can see this was the bullish fair value gap here. The price comes here, creates another kind of SMT, kind of CRT here, and it goes up, right? Price falls down, comes again to this fair value gap. Here also we can look for the lower time frame confirmations, and we can long from here, right? So this was the idea, like how we can frame our bias based on CRT as well as QT. Right? Now, how do we frame bias based on SMT and candle closures for the weekly profile? So for the weekly profile, see, this was the Monday. Monday low was here, but we have one higher time frame period somewhere down there. So on Tuesday, what the price will do? It will take the low of Monday. It will tap that high time frame period. It fails to take low of Monday on the correlating assets, right? And it closes back inside the Monday range. So once this price closes, our bias for the Wednesday becomes bullish, right? So this is our first target, right? This and then this. So when we go to Wednesday, until these targets are hit, we are bullish, right? So here we can look for the lower time frame confirmations to go long. So what the benefit of that is, we will not take the short trades, right? Because if we only observe the lower time frames, there are very possible reasons that we will also short here, right? So there will be some confirmations on 1 minute, 5 minutes, 15 minutes that like break of structure, choch, and fair value gap and market structure shift happening on the lower time frames that will lure us to short. But if we have a clear bias that no, when Wednesday wants to go higher, we'll just avoid those and we will only wait for our setups to go long, right? Now this Wednesday goes up. Now we know when we look at the Wednesday, when we look at the weekly chart, our weekly drawn liquidity was somewhere here, right? Same way that we are observing these daily candles, we can observe monthly cycle and we will have a monthly target, right? On basis of weekly candles, right? So suppose our this week's target was somewhere here, right? So we know until this target is hit, we are not going to short, right? So now this Wednesday closed above the previous day. So now what happens on this Thursday? We can go long. So we'll avoid all this down, we will wait only for our long setups. Once this candle closes above here, we are again long. Why we are long? Because our drawn liquidity is not yet hit, right? So the Friday will be what? Friday will also long. Now what happens? Suppose this candle goes up, but it closes inside. So in that case, what happens? Maybe this Friday will not hit this target. This Thursday might go down, but that will not be high probable because it's a retracement based on the monthly profile, right? So in that case, even if we are trading that day based on our lower time frame setups, our expectations are less. We are not going to target all the way down here or here because we know our drawn liquidity is somewhere here, and this is just the retracement. So the bias does not only help you to decide which direction to trade, it will also help you to decide what kind of targets to expect from your trade setup. If it is pro trend, we can expect longer targets. If it is against the high time frame trend or retracement, if it is in direction of retracement, we can expect shorter targets, right? So this is how we use CRT along with the confluence of quarterly theory to decide which direction we want to trade. So that was a quick video about how I use it, and if you have any doubts, you can ask in the discussion group anytime, and I hope it helped you somehow. I know there were some glitches in the communication because I'm not used to record the videos. I'm just trying my best to convey what I know and whatever can help you guys. So I hope it helps you somehow. So thank you very much for the time being, and we'll see you in the next video. Thank you so much.